Welcome to the deep dive. We sift through stacks of information, really, to pull out the key insights you need to get smart fast.
Yeah.
Today, we are diving into a really foundational text in finance, Benjamin Graham's The Intelligent Investor.
Mm,
Think of it as your, express lane to understanding value investing.
definitely. And we've got some good stuff to work with. The Amazon page for the revised edition, some useful clips from YouTube discussions, and a really solid summary from Novel Investor.
Okay.
Our mission really is to sort of pull out Graham's core wisdom and see how it applies, today for the true investor.
Yeah, and this isn't just some random book, right? It's legendary. Warren Buffett, I mean, everyone knows that name.
Right?
He called it the best book on investing ever written. That's pretty high praise.
Doesn't get much higher than that.
Originally out in 1949, but the version we're looking at has updates, commentary by Jason Zweig.
Which is great.
Yeah, it connects Graham's ideas to, well, to modern markets, even points out similarities to today's financial news.
Exactly. It bridges that gap.
Okay, so let's jump right in. What's the absolute core, the bedrock principle of the intelligent investor?
Well, at its heart, it's what Graham called value investing.
Okay.
And it's not about chasing trends or timing the market perfectly, not at all.
Right.
It's more of a disciplined way to, shield yourself from big mistakes and build wealth long term, carefully.
So the focus isn't necessarily hitting home runs.
No, the main goal is actually minimizing losses, protecting your downside. That makes it right for, well, actual investors, not speculators or day traders looking for a quick buck.
Okay, so a defensive posture, in a way, and Graham was really clear about what an investment actually is versus just gambling.
Oh, absolutely. Crystal clear. For him, an investment operation, and this is key, after thorough analysis,
Thorough analysis, right?
it has to promise two things. One, safety of your principal, the money you put in.
Mm-hmm.
And two, a satisfactory return. Not necessarily spectacular, but satisfactory.
And if it doesn't meet both those criteria?
Then in Graham's book, it's speculation, period. It's a high bar.
Yeah.
Yeah, based on research, facts, tangible value.
It makes me think of that analogy he used, buying dollar bills for, was it 40 cents?
Exactly. Yeah, that captures it perfectly.
Yeah.
Buying something for way less than it's actually worth. Finding that gap between the market price and the real underlying intrinsic value.
Okay.
And that, right there, that's the big difference he draws between the intelligent investor and the speculator.
How so?
Well, the speculator, often just follows the crowd, rides the market waves, maybe without really knowing the business they're buying into.
Chasing momentum.
Yeah. Whereas the value investor, they're grounded, objective analysis, long-term view, always hunting for that real underlying value.
Okay, so value minimizing loss. That's the foundation. What tools or key concepts did Graham give investors to actually do this?
Well, one of the most famous and I think most insightful is his story about Mr. Market.
Ah, yes. Mr. Market.
He pictures the stock market as this business partner you have, but he's really emotional. Shows up every single day.
Every day? Wow.
Yeah. And every day he offers to either buy your share of the business or sell you his share. And the prices, they're all over the place depending on his mood.
Huh. Such a great picture of market volatility, isn't it? The wild mood swings, euphoria one day, despair the next.
Totally.
So how does Graham say we should, deal with this moody partner?
The key, he says, is to use Mr. Market's moods to your advantage. You don't get caught up in his daily drama.
Okay.
You have your own idea, based on your research, of what the business is worth. So when Mr. Market is freaking out, feeling super pessimistic, and offers you shares at a ridiculously low price,
You might buy.
you might buy, exactly.
Yeah.
And conversely, if he's overly optimistic, euphoric, and offers a crazy high price,
Maybe you sell to him.
maybe you sell. It's about having your own rational view of value and not letting the market's emotions push you around.
That's powerful. Being independent of the market's whims. Okay, what's another really core concept?
Margin of safety, absolutely fundamental.
Margin of safety.
It's basically the gap, the favorable difference between the price you actually pay for a stock and your estimate of its real intrinsic value.
So like a buffer.
Exactly like a buffer
Mm-hmm.
or a cushion. It protects you if, your analysis wasn't perfect or something unexpected happens or just plain bad luck strikes.
Okay.
By demanding that discount, by buying something for significantly less than you think it's worth, you build in that safety net.
It's not just about finding cheap stocks then.
No, it's finding them cheap enough that even if you're a bit off in your valuation, you're still likely protected from a big loss. It builds in room for error.
Makes sense. You have to acknowledge you might not be perfectly right. So where does diversification fit into this picture? If you have a margin of safety, do you still need it?
Oh, definitely. Diversification is still crucial. Because even with a margin of safety, any single stock can still go wrong, right? Unexpected things happen.
Sure.
So spreading your money across different companies, maybe even different asset types like stocks and bonds, reduces the risk that one bad apple spoils the whole bunch.
Okay.
Graham even suggested ranges like maybe 25% to 75% in stocks and the rest in bonds, depending on you and the market. And he also talked about rebalancing,
Rebalancing, meaning
just periodically adjusting your holdings back to your target allocation. So if stocks run up a lot, you might sell some and buy bonds to get back to, say, a 60-40 mix.
got it. Keeps your risk level consistent. And it feels important to keep coming back to that line Graham drew, investing versus speculation.
It's totally central to his whole philosophy. Like we said, investing for him. Analysis, safety of principle, satisfactory return.
Right.
Speculation.
Yeah.
That's mostly betting on price moves,
Yeah.
short-term fluctuations, often without that deep analysis. He really wanted people to know which game they were playing.
Okay, good distinction. So we have the principles. Now, Graham breaks investors down into two main types, doesn't he? The defensive and the enterprising.
Exactly. Two paths. The defensive investor, you could also call them the passive investor.
Yeah.
Their main goal is just avoiding serious mistakes or losses.
Okay.
They want decent results, but with minimal effort, minimal stress, not a lot of frequent decisions.
Sounds appealing for many people.
Yeah. Their strategy is typically investing in like large, well-known companies.
Mm-hmm.
Companies that are financially solid, conservative with debt, and importantly have a long history of paying dividends. Stability is key.
So, kind of the reliable blue chips. Did he give specific things they should look for, like a checklist?
He did lay out some pretty concrete criteria. Things like adequate company size, so no tiny startups.
Right.
Strong financial condition, meaning a healthy balance sheet, not too much debt. Earning stability over, say, the last 10 years.
Okay.
A long, uninterrupted dividend record, maybe 20 years or more. Some history of earnings growth over the long haul.
As proven performers.
Exactly. And then, critically, valuation limits. Moderate price-to-earnings ratios don't overpay relative to profits. And moderate price to assets or price to book value.
So finding solid companies at reasonable prices seem sensible.
Very prudent, very disciplined.
Now, what about the other type, the enterprising investor? Sounds more involved.
And it is definitely more involved. The enterprising or active investor is willing to put in the time and the effort.
Okay.
The research, the analysis needed to find investments that might offer better than average returns.
So they're hunting for bigger opportunities.
Potentially, yes. But it requires, significant skill in analyzing businesses, understanding valuation deeply. Graham said you have to treat it like running a business.
A serious endeavor.
Very. And interestingly, he stressed that for this type, knowing what not to do, what to avoid a negative approach, he called it as just as important as knowing what to buy, spotting the red flags.
That makes sense, avoiding pitfalls. Now, did Graham think most regular investors could kind of mix and match these two approaches, be a little defensive, a little enterprising?
He was actually pretty skeptical about that, about finding a successful middle ground.
Oh.
Yeah, he seemed to believe most people would be better off choosing one path, either the simpler defensive route or fully committing to the demanding enterprising approach. Trying to dabble in the complex stuff without the deep knowledge or discipline. That could easily lead to trouble.
That's really interesting. Know thyself, basically. Choose the path that fits your time, skills, and temperament.
Pretty much.
Okay. Now, Graham also had a lot to say about market behavior, investor psychology, things that feel incredibly relevant today.
Oh, absolutely timeless stuff. He famously said the market, in the short run, it's like a voting machine.
A voting machine, meaning?
Meaning it reflects popularity, sentiment, passing fads. Who's winning the popularity contest right now?
Ah, okay.
But he said in the long run, it's a weighing machine.
Weighing.
Yeah. Eventually, it accurately weighs the substance, the true underlying value of the companies.
So short-term noise, long-term reality.
Exactly. And he strongly warned against letting emotions, fear, greed, excitement drive your decisions. That excessive enthusiasm on Wall Street often ends badly.
We've definitely seen examples of that. What about speculation specifically, especially in those, hot stocks or IPOs everyone's talking about?
He was very, very cautious there, especially with IPO's initial public offerings.
Right.
He saw this recurring cycle, right? Frenzies where public excitement, maybe greed, pushes prices way beyond any reasonable value.
Setting them up for a fall.
Precisely. He noted that these IPO booms often lead to big price collapses later on. He actually suggested looking at the opposite end, the unpopular stocks.
Unpopular stock.
Yeah, large companies that are maybe out of favor, overlooked by the market. He thought that could be a more sound area for investment, even if it wasn't exciting.
Interesting. While everyone chases the shiny new thing, value might be hiding in plain sight, just ignored. Okay, so Graham also touched on specific investment types: bonds, growth stocks, mutual funds. Any key takeaways there?
Sure. With bonds and preferred stocks, he advised understanding the basics, like is the interest taxable or tax-free, short-term versus long-term bonds,
Right.
and being wary of high-yield or junk bonds because of the higher risk.
Makes sense.
He did note preferred stocks could sometimes be interesting if a company hit temporary trouble. For growth stocks, he saw the appeal, of course.
Who doesn't like growth?
Right. But he warned strongly against paying sky-high prices based on optimistic future projections. Those projections can be wrong or just too baked into the price already.
So the price might already reflect years of perfect growth.
Exactly. And he pointed out that sometimes today's growth darlings become tomorrow's biggest losers when the sentiment shifts.
Ouch. Good reminder. What about techniques like dollar cost averaging or using mutual funds?
He liked dollar cost averaging, investing a fixed amount regularly, say each month.
Why?
It avoids the risk of dumping all your money in at the absolute market top. You average out your purchase price over time. Simple but effective discipline.
Okay. And mutual funds.
He saw them as a reasonable option for diversification, especially for investors who didn't want to pick individual stocks.
Makes sense.
But he also observed that, on average, most mutual funds didn't actually beat the overall market index after fees.
So convenient, but maybe not a magic bullet for outperformance.
Generally, no. He did hint smaller funds might sometimes do better, but warned against just chasing funds with amazing recent returns. That hot performance often cools off fast and sometimes comes with hidden risks.
Right. Past performance isn't predictive. Okay, so to make these ideas more concrete, Graham used case studies, right? Real companies.
He did. Companies like Penn Central, Ling Temco Vought, these were basically cautionary tales.
What kinds of lessons?
They highlighted dangers like, well, financial weakness hidden by accounting tricks, companies taking on way too much debt for risky expansions, acquisitions gone wrong. Really, the consequences of ignoring those fundamental principles we talked about.
Like financial strength, reasonable valuation.
Exactly. And getting swept up in speculative manias. The Penn Central case, for instance, was a huge bankruptcy, showing how even a big established company could collapse under massive debt. Real-world examples of what not to do.
Learning from history's mistakes. And speaking of history, Graham thought understanding market history itself was really important, didn't he?
Oh, absolutely critical. He believed you had to understand past market cycles, the booms, the busts,
Why?
to get perspective, to understand the historical relationship between stock prices, company earnings, dividends. It helps you make informed judgments today and maybe anticipate future risks or opportunities better. It provides context.
Because history doesn't repeat exactly, but it often rhymes, as they say, especially human behavior.
Precisely. Human psychology in markets seems pretty consistent over time.
Okay. What about the big question? Is investing success down to skill, or is it just luck? Where did Graham land on that?
Well, he used this interesting analogy comparing security analysts to expert bridge players.
Bridge players, okay.
His point was, while skill and analysis definitely matter, consistently beating the market average is incredibly hard. Luck, or just catching good market breaks, can play a big role even for the pros. He also talked about mean reversion.
Mean river.
Yeah, the tendency for companies or stocks that perform extremely well or extremely poorly for a period to eventually drift back towards average performance over time. Stars fade, and fallen angels sometimes recover.
That's a pretty humbling thought for anyone trying to pick winners consistently.
It is.
Now, for those enterprising investors, the really active ones, Graham did lay out some specific methods, the Graham-Newman techniques.
Yes, these were more specialized strategies his firm used. Things like arbitrages, profiting from tiny price differences, liquidations, investing in companies being wound down, related hedges, and finding what he called net current asset or bargain issues.
Okay, tell me more about that last one, the bargain issues, NCAV. Right.
Right, a net current asset value. This was kind of fascinating because it sounds almost too simple.
How does it work?
You look for companies where the stock price is trading for less than the company's net working capital.
So less than cash, receivables, inventory, minus all liabilities.
Exactly. You're essentially buying the liquid assets for less than they're worth and getting the buildings, equipment, everything else for free.
Wow, that does sound like a bargain.
It can be, but Graham stressed you needed deep diversification buying lots of these because some won't work out. And patience. It can take a long time for the market to notice or for value to be realized.
Deep value hunting requires patience and spreading bets widely.
Got it. And what was Graham's take on the overall job of a security analyst? What should they be doing?
He saw their role as pretty thorough. Understanding the business inside out, digging deep into the financials, trying to estimate future earnings reasonably, comparing the company to its peers, and finally, judging if the stock or bond is soundly valued.
So a lot of fundamental groundwork.
Definitely. And interestingly, he cautioned them against relying too heavily on fancy math models, especially for growth stocks where the future is so uncertain. Keep it grounded in fundamentals.
Good advice. Okay, as we start to wrap this deep dive up, what are the big final takeaways from Graham on being an intelligent investor? I think it boils down to a few core things. It's really about mindset, a rational business-like approach,
Mm-hmm.
unwavering discipline, always prioritizing value over speculation.
Right.
And he talked about having the courage of your knowledge and experience,
Meaning,
meaning having the conviction to stick with your reasoned analysis, even if the market is screaming otherwise. Don't follow the herd off a cliff.
trust your homework.
Exactly. And maybe his most practical final thought, getting satisfactory investment results. That's actually easier than most people think if they're disciplined. But getting superior market-beating results, that's much harder than it looks.
That's a great summary. Keep it simple, stay disciplined, focus on not losing big, and satisfactory results are achievable. Okay, so to bring this all home, Benjamin Graham's The Intelligent Investor. Even though it's decades old, the wisdom feels, well, timeless, doesn't it?
Absolutely. It's about building wealth steadily and, maybe more importantly, avoiding those catastrophic losses. Focus on value, understand market psychology, always demand that margin of safety.
And it stays relevant because, as you said, while markets change, technology changes.
Human behavior,
Yeah.
investor psychology,
Yeah.
fear and greed. Those cycles seem pretty constant. That's why his insights still resonate so strongly.
Totally agree. So here's a final thought for you, our listener, to maybe chew on. Which of Graham's big ideas really clicks with you? With your own goals, your own comfort level, with risk?
Yeah, are you leaning more towards that steady defensive approach?
Mm-hmm.
Or does the challenge of the enterprising path appeal to you, assuming you have the time and inclination?
And maybe more pointedly, how can you actually take these ideas like margin of safety
Mm,
and apply them practically to your own financial situation? What does that safety buffer really mean for you?
Good questions to ponder.
Definitely. We hope this deep dive gives you a solid starting point. Maybe check out The Intelligent Investor yourself. Thanks for joining us.